Good morning. It's the 1st of August 2024 and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai. Well, it's the 1st of August, so we're way past the halfway mark in the year. And how time flies, as we always say. So the take. We've been discussing how many young people have been effectively gambling away their savings and borrowings in derivatives trading in the stock markets. Last year, some 9.2 million individuals and proprietorship firms lost about 52,000 crore rupees in index derivatives of the National Stock Exchange. Moreover, of some 9.2 million traders, some 8 million made losses, according to a report in the Economic Times. Then there are transaction costs which add to that 52,000 crore rupee figure. Households are losing up to 60,000 crore rupees annually in the futures and options segment, Sebi chairperson Madhabi Puri Buch said on Tuesday, adding that this was a macro issue. She said it in a public speech. This means that these losses to individuals have larger economic implications, and obviously it's a large enough number to talk about, even in context. According to her, if 50 to 60,000 crores a year was going away into losses in futures and options that could have been productively deployed as maybe the next initial public offer round or mutual funds to other productive purposes, why is that not a macro issue, she's reported saying by Money Control. She had also said earlier that the regulator is not just worried about the micro level where, let's say, losses in derivatives trading might put individual investors at risk, as we've talked about at the core report as well, but also from a macro level where it could potentially disrupt overall economic growth. Now, a study conducted by Sebi earlier indicated that 90% of trades in the futures and options segment resulted in losses, and this is something that we've talked about here on the core report as well. Now, the capital markets regulator has issued a consultation paper, again on Tuesday, proposing a series of measures to curtail these activities and also obviously cool down the markets, particularly the derivatives markets. India has now the highest amount of derivatives trades in the world. So to put that 52,000 crore rupee figure, assuming it's close to accurate in context, an Economic Times report says, quoting Sebi again, that this figure is about 32% of net inflows into the growth and equity-oriented schemes of all mutual funds in the last year. It's also over 25% of the average annual inflows into all mutual funds across schemes for the past 5 years. So the way to perhaps contrast this is mutual funds are long-term investments and obviously derivatives trading is very, very short-term speculative trading, or perhaps if you want to use the word investment. So a fourth of all the money that's going into the capital markets is going into pure and sheer speculation, as I can see. Now, these are large numbers. Moreover, more than 70% of individual investors in the equity cash segment lost money in 22-23. That's the year before last, according to a study by Sebi. Now, there are several questions here, partly on how much derivatives trading do we need and understanding its role, and how should we look at it, even philosophically? While there are several steps announced which may or may not have the desired effect, and we will talk about the overall derivatives trading business with Ajay Bagga, veteran investor, the fact is that we have to look at what is causing it and work on that too. People, particularly smaller and first-time investors, start speculating in stock markets because obviously it has the allure of quick and easy money. And who does not like that? Equally, perhaps they're only trying to fight inflation with their steady or only steadily rising incomes, or in some cases, maybe no other incomes. So we have to address both sides of the problem. And that brings us to our top stories. Stock markets rise, but so does oil. India receives 9% more rainfall in July. Sebi's move to cool down a heated derivatives market, how and why? Toyota's 20,000 crore manufacturing investment in Maharashtra, also a sign of the automaker's confidence in the market. In 3 years, China's exports to India jumped 56% from about $65 billion to $102 billion. How did that happen?
This is the Core Report with Govindraj Ethiraj.
The markets are up again, and so is oil. The benchmark equity indices, the BSE Sensex and the NSE Nifty 50, were strong on Wednesday. The Sensex settled up 285 points at 81,741, while the Nifty 50 was up 94 points at 24,951. Some 21 of 30 stocks in the Sensex gained, with Maruti Suzuki, JSW Steel, Asian Paints, NTPC, among others, ending up 4% higher, according to the Business Standard. Maruti Suzuki, which is also India's largest car maker, also posted a 47% year-on-year increase in standalone profit for the June quarter, amounting to about 3,650 crore rupees, beating street estimates of about 3,467 or about 3,500 crore rupees. Quarterly revenue for Maruti rose by 10% from the same period last year to about 35,500 crore, once again beating estimates of about 34,500 crores. More on auto very shortly. Meanwhile, the rupee dropped to a record low against the US dollar on Wednesday, pressured by month-end dollar demand by importers, according to traders. The rupee declined to 83 rupees 74 paise to the dollar, reported Reuters. Speaking of currencies, we of course focus on dollars. Do you know how we are faring, or the INR or the Indian rupee is faring against other currencies? Well, the pound sterling is now around 107 rupees per pound, while the euro is 90 rupees per euro. Maybe you knew that, or maybe you did not. Meanwhile, the era of low prices right now may just last a week, so perhaps era is not the right word. Speaking of right words, India received about 9% more rainfall than average in July as the monsoon covered the entire country ahead of schedule, delivering heavy rain in central and southern states, according to Indian Meteorological Department data quoted by Reuters. This would also mean that we could stop now worrying, at least in most parts of the country, about the impact of delayed or less rainfall. The problem, however, as we're seeing in states like Kerala, is the opposite. Too much rainfall in too short a time can trigger massive disasters, leading to loss of life and property. Reuters data also said that in July, southern and central regions of the country received nearly a third more rainfall than the average, while the east and northeastern regions received 23% less rainfall. But the overall picture is like this. The surplus rainfall in July helped erase June's rainfall deficit of about 11%. And India at this point has received about 2% more rainfall since the start of the monsoon season on June 1st. So at this point, India has received about 2% more rainfall since the start of the monsoon season. Oil prices jump again. Brent crude prices jumped, extending an earlier gain after Hamas said Israel killed its political leader, once again driving up tensions in a region that produces around a third of the world's crude, according to Bloomberg. Brent crude is now quoting above $80 a barrel after falling about 4.5% in the previous three sessions. As you remember, we were talking about it at around $79. The reason, of course, as we said just now, is a reemergence of fresh tensions in the Middle East after Hamas said Israel killed its political leader in an airstrike in Iran. There has been an escalation in conflict since last weekend, reported Bloomberg. Toyota steps on the gas. On the heels of Maruti's strong results, well, almost, Toyota Kirloskar Motor on Wednesday said it will set up a new manufacturing plant in Maharashtra at an investment of about 20,000 crore rupees. Toyota said it had signed a MOU with the Maharashtra government to examine the setting up of a greenfield manufacturing facility. Toyota's move, if it translates into that plant, obviously reflects the automaker's confidence in the Indian car market and the growth here, and of course its own product mix and their growth. Toyota's hybrids, as we've been talking about off and on here, have been flying off the shelves in the last few years and more so in recent months. So much so that hybrids are now beating electric cars in growth. Toyota is right now headquartered in Karnataka and already has two manufacturing plants located near Bidadi, near Bangalore, which incidentally I visited a few years ago. Toyota says that it's invested about 16,000 crore rupees already in India and created close to 86,000 jobs in the entire value chain.
The core report will be right back after this short break. Are you someone who is sick of the hype around artificial intelligence, but are curious about its potential use cases, whether integrating into a company's processes, or which parts of the value chain will benefit from AI, or whether AI's return on investment is just idle talk?
A lot of companies have told me that they're building their AI strategies. And I absolutely get very scared when I hear that because I don't know what an AI strategy is. What is your business strategy? And within that, what problems is AI best placed to solve?
That is the voice of the president of Nasscom, Debjani Ghosh. She speaks to host Govindraj Ethiraj on the first episode of our brand new series, Nasscom Conversations, a joint production between the Core and Nasscom. The first episode will offer macro insights into the role of AI in business, so don't miss it. The link is in the description. Now, back to the show.
Why Sebi and others are worrying about derivative trading. The Securities and Exchange Board of India has rolled out several proposals largely aimed at cooling the massive derivatives market. The moves include curbing multiple option contract expiries and increasing the size of option contracts. Now, there are 7 measures suggested by Sebi and aim to reduce market speculation, apart from, of course, keeping trigger-happy investors safer to the extent that they can be. Now, I'm not going to get into the details of those steps because they can be a little complex. But let's go to the larger issue of derivatives and how they stand vis-a-vis the overall market structure. I spoke with Ajay Bagga, veteran investor, and I began by asking him how to first define futures and options and derivatives trading and some global context, and then onto the links with the broader market here and whether we should fear anything.
Futures and options, Govind, are derivatives. And what does a derivative mean? It's something whose price is derived from an underlying. Now, the underlying could be a stock listed on the exchange. It could be a commodity like gold, like silver, like some other metal like iron ore or aluminium or copper, or it could be anything else like a synthetic derivatives as happened in 2008 during the global financial crisis when the world had gone mad. So if you don't know about derivatives, I would suggest it's a very good end state to be in and stay like that. Don't try to learn about it. Warren Buffett, Govind said the best quote on that. He says these derivatives are weapons of mass financial destruction. So the mayhem that they can cause is very huge. Why are derivatives used? If you have a basic position in some asset, say a stock or a commodity or something else, you want to hedge, meaning you want to protect yourself against a movement in that price, then you can buy or sell the derivatives. So the derivatives price, it is quite complex. People have got Nobel Prize in economics for, say, devising the option pricing model, which is at the base of all this pricing. That's out of our purview. We don't need to learn that. It involves a lot of abstruse calculations, but it moves in line with the underlying. And there are what we call option Greeks, which give you an idea of how much it will move, how much a change in the macro, like an interest rate change, how much would that impact the pricing of a derivative. So there's a lot of mathematics. There are a lot of high frequency traders, Govind, who have huge machines, who are looking to make a few paisa on every trade, and continuously they have algorithms which are programmed, and those are running continuously looking to buy and sell.
So let me pick up on the statement that the Sebi chairperson made yesterday, which is that households are losing up to 60,000 crores annually in the futures and options segment. So now this figure has been contrasted with some other figures, including the net flows into mutual funds, and it appears to be almost 1/3 of that in the last year. But my larger question is, where are we now in terms of the manner in which this has expanded and grown? And secondly, is the way prices move in the futures and options space, is that affecting the main market?
It is not affecting the main market. It's a derivative of the main market. But what happens is if too many people lose too much money. So right now, Govind, there are 93 lakh unique traders in our markets. 93 lakh unique PAN have been identified who are trading in our markets. So 1 out of every 140 Indian is on this market, which is a huge ratio. The risk is now the 60,000 crore number will need a lot of study because there are people who genuinely hedge positions. Suppose you have a portfolio which is worth 50 lakhs, 1 crore, and you want to hedge against the chance of it going down 5%. You go and buy what is called a put option, that in case the price goes down, I will be rewarded. So there are various strategies running in this market. I think if you had a 60,000 crore loss number, you would have much more noise. You get this anecdotal knowledge that somebody took the wife's ornament, sold them, or somebody mortgaged their house and lost everything. Or, as we had seen, if you remember, an automobile major at a foreign bank a few years back, 400 crores, a foreign bank RM and one or two other colleagues of theirs took the family office money of an automobile major based in North India, and they lost 400 crores trading derivatives. The foreign bank made it up to that family, but that had become a very big issue. So I don't see the pain in the market of 60,000 crores having been lost. Again, I am an ivory tower sitting in my own cocoon. I don't meet hundreds of investors, but the investors I meet in investor camps are very successful people. So 9 out of 10 Indians apparently are making losses in this futures and options. 7 out of 10 are making losses in the cash equity segment, the cash price equity segment. So there should have been a lot more noise. I mean, it's nearly like a Manrega budget has got, lost in the market. I find it very strange, though it is true, Govind, that there is a hedge fund called Jane Street, and they got into some trouble and they had to make some court filings. And it came out that just one strategy of theirs in the Indian market had made them nearly $1.5 billion or $2 billion over 1 year period. Just one strategy. So there could be multiple strategies. So that is true. If somebody has lost 60,000 crores, it's not a zero sum exactly, but there will be profits. But I don't see that noise. But again, I'm not a representative sample or a big enough sample.
Anyway, so let's put the figure aside. I think the statistics in terms of the number of people who are making losses, that's one. Second, I think if you correlate it with the fact that many of these people who are making losses are young, they're mostly below 30, which means they're logically, have entered the markets only recently. And that obviously has its own set of problems, which may not affect let's say, the integrity of the market, but will surely affect them and their, let's say, financial positions, particularly if they've borrowed. So what's your larger sense, Ajay, when investors look at the market now, obviously derivatives for whatever reason or many reasons appears lucrative and quick because you can day trade and you have the feeling of making quick money, whereas long-term investment or investing is a completely opposite strategy of that. So how would you suggest people should look at this? And will all these moves by Sebi to cool things down help?
Yeah, one is people don't try to get rich quick because, the fast money pays for the patient money. That's a truism of the market. The patient investors will take the money off you. Second, if you're a retail investors, you don't stand a chance against the institutional investors who have huge computing power, who have professionals who are doing this 24 hours a day, and who have huge algorithms, computer models, which are working to find out people like us and take our money from our pocket. So it's a mug's game trying to get rich quick. It ends in disaster. Second, the danger in derivatives, Govind, is that with 1 rupee, you can actually have a position which is worth 6 to 10 rupees. You can get a lot of leverage. And that's where the issue comes. So if you make a percentage-wise loss, you can wipe out your entire capital. Cash equities, why 7 out of 10 lose? Because you can lose only your capital. So if you are down 2%, you lose 2% of your capital. In the derivatives, if you're down, say, 12 or 14% or 15%, you might end up, destroying your entire capital base. That is the risk. So these are very toxic, not meant for retail investors, not meant for the untrained investors. What happened with COVID, Govind? This Robin Hooders breed grew all over the world. It's not only in India, it's a global phenomena where discount brokerages came in who provided access these technical software came in. So you thought looking at a few market, curves and market indicators, you became a market master. And there were various workshops and strategies being offered to the retail investors who thought that you will get rich and double your money on a daily basis, and you end up losing. So it was a COVID phenomena where gamification, and it became like a video game. And also, what happened is that it became a gambling casino. So the market became a casino that you come and bet every day and you take money. It's not a betting place. It works on fundamentals. In the end, it is based on corporate earnings and cash flows in the short term, whatever it might work on. That fundamental thing got lost out, Govind. So it's not a good place for retail investors to be in, and they will lose money. Not even I would say 9.99 times out of 10, retail investors lose money in these markets. Corporates also lose huge money. You would remember the case of Orange County, where an entire municipality went bankrupt. Corporates went bankrupt, and 2008, where 100-year-old institutions worth $600-800 billion of market cap.
Lehman Brothers, yeah.
So that's why Buffett calls it weapons of mass financial destruction. They're not for you and me.
Right. That's a very emphatic and good note to end on, Ajay. Thank you so much for joining me.
Thank you.
Why India's imports from China are skyrocketing. Now, if you follow popular media, then you perhaps know that India has been waging a trade war against China, including back home filing tax cases against Chinese companies and notably those making mobile phones, and then banning over 300 apps from Google and Apple Play stores. TikTok is the most prominent of these apps, which is not available in India now thanks to these moves. All of this is in retaliation for the mischief that China has been up to at the roughly 3,500 kilometer border that India shares with China. But for all the high decibel media noise that you would be right in thinking that trade between our countries is shrinking and we are steaming full speed towards a China plus one strategy where companies move manufacturing capacity from China to India or add India as a prominent backup and as a future investment. Well, it's not quite that. In the past 3 years, that's 2021 to 24, India's imports from China have increased by 56% from about $65 billion to about $102 billion last year. On the other hand, India's exports to China have decreased by 21% from about $21 billion in 2021 to about $16.7 or $17 billion in the last year, that's 2024. Some China plus one investment is obviously happening. The most talked about or heard about one is obviously Foxconn's manufacturing in India for Apple iPhones, which are mostly exported. Last year, for example, Apple made about $14 billion worth of phones in India, or 14% of total production, with exports crossing $10 billion according to reports. Now, the price at which those phones get sold at is obviously higher. So why is this happening? India's position now seems to be that we need Chinese products and Chinese companies to manufacture in India, which would obviously help our overall state of competitiveness, particularly if we import components at lower prices than what we were earlier. I reached out to Ajay Srivastava, former Director General of Foreign Trade Official, who now runs the Global Trade Research Initiative in New Delhi. And I began by asking him why the numbers, which is imports from China, had jumped so significantly, without, of course, getting into the geopolitics of it.
Imports from China increasing, and the root cause is that we are very much dependent, almost critically dependent on China for our industrial product imports. And if I divide industrial products into 8 categories, machinery, electronics, chemicals, pharmaceuticals, textiles, garments, etc., in each of these 8 categories, China is number 1 import supplier to us in each of these. So the general perception is that China is good in electronics. They are supplying us a lot of electronics, some machinery, some capital goods. But no, it's amazing that they are number 1 import supplier in all the categories. That's how we lost the space in the past 20 years. If you recall, in about year 2000 to 2003, the data which China submitted to WTO, it showed that India and China had equal trade. In fact, India was having some minor surplus. But since then, China has taken off and our imports have gone up So overall imports in industrial products, 30% comes from China.
Right. And of the total trade of $118 billion with China, that's bilateral, imports are about 102 billion. So we are only exporting about 16 billion.
Yes. The exports are stagnant for the past almost 5 years, but imports are jumping.
Right. So now there are two parts to this. So there is obviously a geopolitical shift that has taken place, which I'm not focusing on so much. But the two parts is one is that we are importing products. And secondly, we also seem to be now open to more Chinese investment driving manufacturing locally. So how are you seeing this play out?
In fact, this CAT was said for the first time in the economic survey. They said that the precise wording is this. They said that India should welcome investment from China so that we can manufacture and export things and export them to US and European Union the way Mexico and Vietnam and South Korea are doing. But if you look at this is not workable. Large chance of Trump coming back to USA. In March this year only, he noticed that how China is going to Mexico and other countries, setting up shops there, plants there, and trying to supply to US. So he specifically warned Chinese automakers. He said, if you are coming to Mexico and want to supply to US, I'll be escalating the trade war in a big way. So how can we take such a risk? It's our preamble that we want Chinese investment for manufacturing here for supplying to US. It's not going to work. And second, forget about the Trump's reaction. What's our policy? China is a big country and we need considered policy. And India has a considered policy, even though imports are increasing. But we were grudgingly acknowledging that imports are increasing. We should do something. PLI was an attempt in this direction. But not only that, we wanted to reduce dependence on China in a number of ways. For example, we signed 3 pillars of Indo-Pacific Economic Framework. It's a setup almost like an FTA led by US and 14 more countries to shift our supply chains away from China. Then we have joined supply chain resilience conditions initiative with the US, Japan, Australia, etc. To find alternate supply chains, alternate to China. So this hint from economic survey, it was a surprise to people like me. We thought we are going away from our policy. And if we follow this policy, there will be large-scale contradictions. How you explain you are joining IPF also and you are inviting Chinese investments also?
Yeah. So as you look forward, how do you see imports now making India more competitive, perhaps? For example, in the case of iPhones, the fact that we are able to import, let's say, the raw materials or the input components at a lower cost obviously makes things easier for us because we've reduced import duties. I mean, that's one example. There could be many others. So all in all, how do you see this playing forward? The fact that we're now more open to Chinese imports, particularly, I'm sure, at lower cost as well.
You took the example of smartphones, not too happy with that, because for high-end smartphones, the valuation would be less than 10%. And so we are not importing even the components, we are importing sub-assemblies, and we are putting sub-assemblies together into making smartphone and sending it abroad. So import content could be very high in such things. There is no deep manufacturing in India. So if tomorrow the people who are manufacturing a smartphone, they shut shop and go, we have not learned anything. We don't know the technology of making it. So unless we focus on, say, component making, we focus on deeper manufacturing, we are nowhere. And each country, be it South Korea or China, Japan, they all did this the hard way. For example, Japan in their 60s and 70s, they emulated American technology by reverse engineering everything, opening the cars and then reassembling, learning by. China copied both Japan and Taiwan and USA. Everybody does that way. So I want to highlight this, that if we divide all the manufacturing, say, in two very broad, simplified parts, one is high-tech and second is not so high-tech. Not so high-tech, most of the products, they can be reverse engineered. But India, we talk a lot, but the field level, we need to do seriously how we can promote reverse engineering of the products where not very high-tech technology is required or biotechnology is required. About the high-tech, it's a hard way. We have to invest in R&D and it will take 20, 30 years. It took that amount of time to Japan, Korea, everywhere, Germany, everywhere. And we should be willing to invest that time for future. And this is the only way. There is no simplistic way to promote manufacturing. We are doing band-aid in the name of most of the manufacturing. I think we need to change our thinking and think long term, think deep.
So if you look at light engineering or not so high tech, as you said, now, I mean, I think many people have tried it, but for various reasons, it's not succeeding. I'm assuming because also we are uncompetitive at some levels. I mean, for example, let's say maybe cost of energy, or there may be other subsidies, implicit subsidies in the way Chinese companies are manufacturing. But the PLI scheme was one step to counter that. Now, it is working to some extent, there's no doubt about that, but perhaps not to the extent that we need if we are trying to counterbalance, let's say, Chinese imports. So, in a broad sense, how do you then see the way forward?
I totally agree with you. We are having high cost of doing business. Our interest rates are high, cost of capital is high, and power is not UPS. Uninterrupted power is missing in many places. People have to put their own power supplies. All these things, they increase the cost. There is no other way but to address this. We cannot address this immediately, but we have to address this sector by sector. There is no other way. If we study how all these countries from Germany to France to South Korea to Japan, they have grown up, we have to strengthen our fundamentals. We have to strengthen the fundamentals. We cannot just be taking care of the outer part. We just cannot be importing everything and putting in a box and exporting it and be happy about this. There is no other go. Manufacturing is a long-term game. We think it should be done in 2 years' time, 3 years' time. No way. But as I say, for 90% of the products, reverse engineering is the way. Let's try doing it. And imports will continue. Overnight miracles don't happen, will not happen in this case also. But at least I say, even if we are not succeeding, let's get our recipe right. Let there be a deeper discussion at the national level. What is the recipe? The current thing is importing everything, putting in a box and exporting is not the recipe. So first we need to have a understanding of what is the best recipe and then work on it. It will take time.
Right, Mr. Srivastava. Thank you so much for joining me.
Thanks, Govind. Thanks for inviting me. Thank you.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.